So let's go on with talking about the bond market. And this is from the Financial Times just, let's see, a day ago. And they talked about a bond bubble, the fact that prices of bonds were so high, and in many cases, interest rates are dropping down into the negative ranges, especially for government bonds, particularly in Europe. And so let's sort of think about this. So this says the warning coincides with mounting fears that a dangerous pricing bubble has developed in the fixed income markets, where bonds worth $15 trillion, about a quarter of the debt issued by governments and companies locally, are trading at negative yields. So let's think about what's happening in this case, but let's go to the bond market. Think about that, and there's several other cases as we think about this. So let me go to the whiteboard to sort of talk about this. And let's go in here, and let's go. Okay, so when we're thinking about the bond market, we have on this axis the price of bonds. And I guess the key thing to think about is that there's, as you're going in this direction, you're getting higher interest rates or higher yields. Okay, so as the price goes up, interest rates go down. As the price comes down, interest rates goes up. That's what I went over in the last part of this lecture. And so you can think about it's a simple supply and demand framework. So there's a demand for bonds here, and there's a supply of bonds here. Okay. Well, we can also then think that there is a price of bonds in which it's going to correspond to a zero interest rate. So we'll call this a zero interest rate. Okay, at this particular level here. Now we've been seeing a situation in which there's been increased demand for bonds as a safe asset that's out there. But what's also happening is, so we have the sort of the standard increase that we've gotten to hold on to bonds. Okay, so here's our D2. But then what's been going on recently is that governments have been buying into the bond market. So it was really back during the global financial crisis, there was something called quantitative easing. And this was an expansion of the Fed's balance sheet and the European Central Bank's balance sheet and even the Chinese Central Bank's balance sheet. But what they were doing was often, putting reserves or that high-powered money into the system in response for buying up bonds. Well, usually these were short-term bonds for the most part. But then towards the end of the global financial crisis, the Operation Twist actually had us moving into buying longer-term bonds to try to get at lowering those interest rates in the longer-term fixed income markets that are out there. So recently the Fed, when their balance sheet has included a lot of things like mortgage-backed securities and stuff like that, well, they've just announced that they're going to do more traditional bond buying, more traditional increases in government debt, holdings of government debt, that partially because of what's been going on in those short-term liquidity markets, they want to return to some of the more short-term stuff that's out there and the more traditional things. So they're moving in there. The European Central Bank has for quite some time been buying bonds out there, and they've been doing the quantitative easing that's out there, but they just announced that they're going to do more of this. So what we have is a twofold thing. One, we have these governments increasing the demand for these bonds, okay? But they're also signaling that they're going to do more of it. So there's an anticipation not just of moving into the zero range, okay? But if these central banks continue to buy, they're going to push these even further into the zero range. Well, we're used to thinking of, the interest rate as the factor that we're going on, but what we're really seeing is all of this is driving up the price of bonds, okay? When you see this in the bond market, then what happens is that this tends to push up those prices, and that's what you're selling it for, right? When you're selling a bond, from one to the other. Now, this pushes it into that zero range and below zero. So we've had actually, in this range, we're actually getting into negative returns. And at some level, to me, this makes no sense, because especially when you're thinking about, say, a 30-year German bond, that for me to set up my retirement and buy these bonds so that I put more money into this account than I actually am going to get back 30 years into the future sounds insane to me. I might as well just, hold my cash if that's the case. But you can also think of it as there's just such a demand for these bonds that it's driving the price so high that it's resulting in these negative yields that are out there. And so it still doesn't make that much sense for holding to maturity in some respects, but maybe there's some idea amongst individuals that they're going to be able to sell these things and so get some sort of return on them. I can see where the governments want to do it, to keep returns, keep the costs of credit low so that firms can have financing and those sorts of things that are out there. But it still seems rather bizarre to me, that anybody would want to hold these negative rate debts, except for they might be thinking they're going to resell them if the price goes up even further. But I think this is one that fits into the category of bubble. Okay, that I also think that because these are things that people aren't going to want to hold to maturity, and if the prices start coming down, and you're holding these things, they're going to be pretty illiquid. So I also worry that this might also add to those future liquidity problems that we've already been seeing, that have happened in the repo market and some other areas that are out there. Okay, so that's thinking about negative interest rates using this bond market analysis. Let's think about a few other things. So one of the things that happened and the global financial crisis hit is, that we ended up with, a huge expansion in debt. Okay, so again, thinking about our price of bonds over here, we ended up with a huge expansion of debt. And so what is that? That is like, we're thinking in our supply and demand framework, that debt, especially government debt, is a huge expansion in the supply of bonds. Okay, and all during the first, actually continuously all the way up till like 2016 or something like that, we heard things from the bond vigilantes, this idea that interest rates were going to skyrocket because of the burgeoning debt that was taking place. But that really didn't happen, even though we did get this massive expansion in debt. So the supply of bonds radically increased, of government bonds, because there was almost an unlimited demand for, this government debt. So even while the supply was expanding dramatically, the demand was expanding almost as dramatically. So where we would have had this big decline in the price and an increase in interest rates, what we ended up getting was still interest rates remained low over a very long period of time. There just seemed to be this sort of unlimited, domestic and international demand. And part of that had to do with these bonds. US government bonds were seen as very, very liquid. And so in the crisis, they became, the major port in a storm is to go and move into this government debt as a way of, keeping assets very liquid on there. And so even though there was this massive expansion in debt, there also was this massive increase in demand for that debt that took place. Okay. Now, we had a similar type thing, during the 2000s, that during that period we had another expansion of debt with the Bush tax cuts, and, with the spending for, the Iraq War and, the Afghanistan War and wars. And so what you saw was, a massive expansion for that Iraq War, excuse me, and for a massive expansion that took place because of those tax cuts and the other spending that took place in this. And so this created, increased supply, as we see here as well. The demand came because we're running such huge, current account deficits that money was flowing to Asia, and Asia had two choices: either hold on to the cash or turn around and buy US bonds. And so once again, the demand for US bonds, in this case coming dramatically from East Asia, increased dramatically, keeping those interest rates from skyrocketing. So again, sometimes even with a massive supply, what really matters is the balance between supply and demand in that. So this is how the bond market works. Now, one other issue is to visualize something I'm going to get to in a minute here, called the Fisher effect. And I'll come back to this in the whiteboard in a moment, but let's go and sort of look at that. So let me move into thinking about our PowerPoint. Okay. And so coming back to this, coming back to our exhibits here, let me skip ahead here because I want to talk about that Fisher effect and then go back to the PowerPoints, and then I'll come back to the yield curve at the end there. So, excuse me, there we go. Okay, so there's something in economics called the Fisher effect. It's after Irving Fisher, who was an economist, Harvard trained and economist, and Irving Fisher sort of misses the Great Depression. He has this classic quote that stocks have hit a permanently high plateau just before the 1929 stock market crash. It's one of those, they didn't have tweets back then, but this would have been a tweet that just hung around his neck for the rest of his life. On the other hand, he had a pretty good theory about, after the fact, about why the Great Depression had taken place, and it was this sort of, was called the debt deflation, the combination of high debt combined with deflation. And so, and it sort of relates to this idea that I'm going to cover now called the Fisher effect, that the combination of falling prices and high debt can be catastrophic. But it's also something I want us to look at in that bond market. So let's start out and think about something called the real interest rate. So the real interest rate right here, okay, R is our real interest rate, and it's equal to the nominal interest rate. So that's the rate if you go into and get a mortgage, you get a 6% mortgage. That's a 6% nominal rate. But then if you want to find out the real value of that, you have to subtract out inflation. So I always like to start and think about my own experience on this. When I took out my student loan, it was at 13%. I'm sorry, oops, let me go back. It was at, I'm glad it wasn't at 13%, but it was at 9%, okay? But at the time I took it out, the inflation rate was 13%. So in actuality, if we use this equation, took out a 9% loan, 13% inflation, that gave me a minus 4% interest rate on it. Okay, so it was a pretty good deal when I took it out. Unfortunately, well, maybe fortunately for the economy, but bad for me in paying back my loan, inflation fell in the ensuing years that took place on that. So, and my real interest rate went up somewhat on that, but there's still a pretty good deal on that. I think the lowest inflation got in that period was about 6%. So I ended up still with like a 3% real rate on that. So that's the real interest rate, and you know that's something to always keep in mind on it when you're thinking about taking out loans and things like that. On the other hand, what Fisher argued is, and it's sort of a social science precept, that knowledge of this particular relationship means that we're going to react to it. So Fisher argued that what would happen is if someone wanted, say, a 6% return, and they knew there was going to be inflation, so expected inflation, that's what that little superscript E means, and we always use pi for inflation, so this is inflation here, okay? But this is expected here, and so if we expect, say, 5% inflation, we're going to charge 11%, okay? And then if everything pans out, then we come back to this real interest rate question here. And so suppose that everything works as planned. So we charge 11% and there is 5% inflation. Then we get our real interest rate there. Okay. Okay. The real issue is if there's higher than expected inflation or lower than expected inflation. So if there's much higher than expected inflation, say there's 8% inflation, then we end up only paying 3% real interest. On the other hand, suppose that there is much less inflation. Let's go to the extreme. Let's suppose there's minus 10% inflation or deflation. Okay, we were expecting 5% inflation, but they actually fell by 10%. Then we've got a negative, which you add those two together, and we'd end up paying 21%. Okay, this is why deflation can be so catastrophic for debtors, because their real interest rate skyrockets. I once figured out when I was looking at the farmers' movements in the late 19th century that they were paying about 12% in nominal interest rates a year. And then they were facing anywhere from 10 to 15% deflation a year. And so it was minus 10%, minus a minus 10%. And so they were facing real interest rates of 22%. No wonder there was so many farmers' movements in the period, because they were facing these extraordinarily high interest rates because of the deflationary pressures that are out there. Okay, so the idea of the Fisher effect is that inflationary expectations drive up nominal interest rates. Okay, in words, that's what happens. Inflation drives up nominal interest rates in there. So let's go back to our whiteboard and see how this plays out in the bond market. Okay, so come back here. Let's start. Think about how the bond market works. Okay. And our supply and demand. Now, since this is a fixed income asset, you get regular payments, and inflation tends to weed away the interest payment, the interest on it, or the return that you get on this, because you're getting a fixed payment each year. If you're the issuer of this, you kind of like inflation. So as long as it's not filtered into the interest rate at the beginning. So for a given price of a bond, then what you're looking at is more inflation should make you want to offer more of these, to issue more debt, because you're actually, what you're going to pay other people as you borrow their money is going to be worth less and less. So this should increase the supply of bonds out there. On the other hand, so let's assume that we start at point A. If you're thinking about buying a bond, the anticipation of a lot of inflation should make you think twice, unless you're going to get some type of a bond that protects against inflation. There's something called a Treasury Inflation Protected Security, a TIPS, if you will. That actually pays a real interest rate, not a nominal. But most bonds pay nominal interest rates, and so inflation makes them worth less and less. So then you see the demand for bonds come down. So what is the effect of inflation? Supply increases, demand decreases. That brings down bond prices, which increases interest rates. What is that? Inflation drives up nominal interest rates. That's the Fisher effect, just seen within the confines of the bond market that we have here. Okay, so I might not have shared on that one. That's things. Okay. Let me stop there to make sure that I've done that correctly. So I'll stop this segment.